Hey everyone, Bob Kendall here. Just want to thank you all for watching my videos. If you do want to support the channel, go to www.kendallreport.com/wavetech. Sign up for our software. You get market grid on 165 individual stocks and indices. You also will get 16,500 buy and sell signals on our entire database. I thank you so much for supporting the channel. Those of you who have already signed up, thank you so much. Welcome everyone to the Kendall Report, where I share my 41 years of experience to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. Before we get started on this week, I just want to take a quick look back on last week as we saw the S&P down 0.7, the NASDAQ down 1.6, and the Russell down 1%. So we did see some churning up here. We're still seeing a lot of momentum, and other structural parts of the market start to fall apart a bit here, and it still looks like there's going to be some consolidation and some possible downside. I'll go through all the details here in a few minutes in the technicals. As we look at this week, this will be the final major week of earnings reports to come out. There's about 1,020 coming out, and there's some major players coming out primarily on Tuesday and Wednesday, and that's where most of the sentiment's likely to be affected. I still believe that the earnings are the only thing that could drive the markets into a more positive tone, but there's so much out there. I think market participants are looking for something else. Of course, we always have to remember that there's the risk of Janet Yellen coming out and screaming about stimulus and big stimulus and all that stuff. So that's still out there. It's interesting that so far the current administration has said that there's going to be $2,000 checks out there. We're going to come out right away, and they're still not out. And as I keep telling you folks over and over, it doesn't matter who's in the White House. These folks at Congress and the House are incapable of delivering anything. It was real easy last year. Everybody was on board, do it. Now everybody's playing the game with trying to get their special program in. So we're back to business as usual. That's not a good thing, to say the least. As we look at the economic reports that are coming out this week, probably the biggest thing that will be out this week is on Thursday, where the personal income will come out. We're looking at that to increase about 9%. Spending is expected to come out about 3.5%. Then, of course, the numbers that I talk about every week that have the most impact on sentiment are those claims numbers. Still expected to see an 835 number. They came in much bigger than expected last time. And the continuing claims I talked about for months and months, I don't believe these are in play right now. I don't think there's going to be any material change in that number, and I don't think it's as impactful as it was several months ago. So that report is somewhat off my radar screen at the moment, but we'll keep an eye on it. If it did come in under 4 million, that would be impactful. We'll just have to wait and see. I'll update you more on that as we get closer to Thursday. But for the most part, this week is going to be more absorbing everything that's happening in the markets. The big event last week was the Treasuries moving up to 1.35% on the 10-year. This continues to drive the sectors that I've been talking about on the database on the intermediate, primarily the financial and energy. Financials were up 2.8% and the energy was up 3.1%. So those are definitely sectors that are still in play. I still believe that they're in their early cycles as far as the positive rotation that's going on in those sectors. So there's probably lots of opportunities. I'll go through that here in a minute and when I go through the database. A quick mention about the database. We are seeing a rotation on the short term. So I'll go through all the details in just a minute. But as we go forward in this week, expect market sentiment to drive that. And the hard part right now is figuring out what market sentiment is. It looks like there's a positive bias, but it's also hesitant because everybody's centered in on the expectations for stimulus. I don't think we'll see anything on that at all this week. Who knows? Maybe they'll surprise us. They may jawbone it. They may talk about it coming. There's not likely to be a real event to push the markets. Let's go ahead and take a look at the charts, see what they're telling us for this week. As I review the WaveTech database, we'll start with the intermediate database. there was not a lot of activity. We did remain at the 84.42% bullish, but as I mentioned in the opening comments, those sectors that are rotating are financials. They're 46 days into a 245-day cycle, and we're also seeing energy in play as well, which is 56 days into a 300-day cycle. And what that means is typically these models on this sector will, on average, will hold these positions for this length of time. So 300 days on energy, 244 on technology, and that is likely to continue to drive these markets. On the top end of this, if we sort this, we can see that the extended sectors are basic materials, consumer non-cyclical, consumer cyclical, and conglomerates. Those rolling over and rotation on the bottom end of the sectors. As we go to the daily database and review the output of the models for Friday, there was about 650 sell signals, but there were 1,100 buy signals, which upticked the database back to 49.63%. And as I always tell you, I'm both on the intermediate and the short term or the daily models, this is important to remain right now above 42% on this index. As far as the intermediate goes, we're up in 84% bullish. This is not really a factor. The one thing I do want to cover before we leave the database is taking a look at the profit fulfilled. And even though we're into the beginning phases, the current average duration on these symbols on a short-term basis are 10 days, typical hold 40 days, and right now we're looking at the percent fulfilled, only 25%, but 60% of the profits have been fulfilled. And one of the things we're starting to see here it's beginning to get very extended here as we are 84% long. The average holding period is 209 days. The current holding fulfilled is 41%. If we look at the average profit is 30% on these trades with a standard dev of 72, but the current average profit is 27 or 92.8% of the profits on all of these symbols have been yielded. So we're getting very extended from a price standpoint. So this tells me that there is some potential for some downside risk here. If we don't see an acceleration on this pattern that I'll review here in a minute, we're going to see some liquidation come into the intermediate models. Now, that doesn't mean markets rolling over and it's the end. It does mean that we could see a larger corrective phase start to emerge. As I begin the review of the S&P 500, starting with the futures, what we're seeing is the market for the last two sessions has traded below the 10-period moving average. We're watching the PPMs roll over. They're getting very close to putting us in negative territory, suggesting a minor downtrend is forming here. The major support is at 38.12. You'll see when I go through the weekly charts on SPX that this is a critical level on the charts. Now, this rolling over has been very methodical. As I mentioned in the opening comments, there is a lot to absorb this week, primarily in earnings. There are some other reports that are coming out. Consumer confidence comes out on Tuesday. That could affect the markets as well. Also, we're seeing LEI come out on Monday. I don't see that having much of an impact. That's leading economic indicators. But the consumer confidence numbers could be impactful to the sentiment. And as I mentioned, sentiment's what's going to drive this market. So we're trading between the 21 and 10 period moving average. 38.58, 39.11 is that upward average. And we're seeing some negative trading overnight with the futures down 12.50, down 0.32 on the session. Let's go ahead and take a look at the SPX and go through the cash. The cash market has continued to hover right at that 39.15 level. We closed just below it on Friday, and we're continuing to hover on that, but it's only up 0.9 on PPM1, PPM2 0.06. So we're very close to rolling over. We're seeing the PPMs actually cut through their first and second derivatives, and this is going to continue to put some downward pressure on this market. Let's take a look at the market grid for today on the cash. And what you see there is the S1 is 38.99. We're already going to open below that. S2, S3 is the likely lows today. 38.74 would be the extreme. The numbers I just mentioned, the 21-day moving average, 38.62 would be well below the expectation for even going to an STX. But we could see, most likely what we'll see is an S2, S3 low today. R1 would be the high if they can get a rally to go at all, based on what we're seeing overnight. We're seeing a 12-handle sell-off in the futures. It's not really that drastic, so we could see an R1, S2 tomorrow. More likely we'll see an S3 on the downside, which would put us at 33.90, and it won't take much to get us down to the STX number of 38.81. And the key number here is going to be 38.04, which is the 10-week moving average, very similar to the 40-day moving average. So 38.08, 38.04 is going to be major support. PPM1 is still up at a 0.64, PPM2 0.80, and PPM3 0.76. So there is substantial support. As we look at the market grid for the week, we're looking at a S2 is 38.58. That would set us toward that level that I just mentioned. And STX this week would be 38.11. So that would be a test of that extreme 40-period moving average on the daily charts and the 10-week moving average at that 38.04. So we could see that. Most likely what we're going to see this week is a minimum of an R1, S2. Most likely we could see the extreme being S3 for the week on the SPX. As I review the NASDAQ Futures, we're seeing some overnight weakness, down about 0.5%, down 63 handles right now. We're trading at the 21-period moving average, and this has been the case for multiple months, as the NASDAQ is leading up and down for the most part. We're seeing the moving average at 13,499. As we look at the market grid for the week, we're seeing somewhere around S1 is 13,521. We've penetrated that. S2, 13,460. Probably see an S3 here at right at the 14,000 level. And the ultimate support will be the 40-week moving average, which is quite a ways down at 13,212. I don't see that being reached this week, but we certainly will see an S2, S3, and R1 is likely to be the higher end of the range. We could see a potential of spiking up to 13,691, but this is a daily grid, and I don't see it getting above R1 today. 16,630 would be the extremes. Expect an R1, S2 level for the day. Reviewing the weekly chart, similar type configuration, but as I mentioned, on an intermediate level, we still have a PPM1 of 0.61, PPM2 0.87, PPM3 0.89. Now these PPMs are price pressure momentum indicators. Right now it's indicating there is support, but we have penetrated through the first and second derivatives, which ultimately suggests that we will penetrate this level at 13,225, ultimately heading towards 12,583. This pattern is continuing to roll over and fail, even though we were able to print new highs week before last. We did get a reversal pattern last week. We got an outside bar, which tells us if we close lower on Friday, we're going to have at least 2, maybe as many as 3 weeks lower in this pattern, and the probability suggests we'll get to that 12,583. The final market I'll cover tonight is gold. Gold is trading up just about 1%. It's up 15 handles right now at 1792. We're seeing some strength as we're looking at the daily chart. We're trading close to the R3 number at 1797. The RXT number is 1804. If you recall, 3 days ago, we did get an STX buy signal, which suggests we'd get at least 1 to 3 days of a sideways to upward bias. We're seeing that. The key element here to watch is that 10-period moving average. Right now it's at 1806, and that's going to be a ceiling for this market. It coincides perfectly with the RXT number at 1804. On the downside, for the next couple of days, I do believe that this low that we established on Friday is going to be a significant low in the pattern at 1759. This was a lower low than we made back in November at 1771, but we still have downtrends with PPM1 down 0.22, PPM2 down 0.17, and PPM3 down 0.12. So we're not quite in full out trend levels here, but we're definitely got downward pressure, which will keep a cap on the markets somewhere around that 1806 level. Looking at the weekly chart, the expectation is for an R2. We've traded at R1 already. The high has been 1793.30. Chances are we'll move higher than that. 1812 will be the high. And just looking at it from a market grid viewpoint, 1760 is S1, which maps out perfect with last Friday's low. I don't think we'll get that low, but we certainly could retest that low. And if we got through it, then 1742, 1724 is the extreme. On the upside, like I said, 1812 is likely to be the cap for this market. We also have PPM 1 and 2 are in trend modes on an intermediate basis to the downside. So we're in a negative trend. 1837 is the 10-period moving average. That's going to be the absolute ceiling. That would be an R3 for the week, just looking at the grids. I do not see that happening, but I do see a potential for an inside week after the big drop that we saw last week. We're likely to see some of this retracement back up toward these numbers. 1812 has got about a 60% probability and about a 40% probability to get to 1830. This will complete the video for tonight. Thank you for watching. We'll talk to you tomorrow night.